trade that hurts you the most is often the one you never take. Not because you missed the entry, not because your analysis was wrong, but because you spent so much time chasing small movements that you weren't prepared when the real opportunity arrived. Think about that for a moment. How many times have you been busy reacting to every fluctuation, only to watch a major trend unfold without you? The market offered something meaningful, and you were occupied with something insignificant. That's the hidden cost nobody talks about. The secret of big moves is that they rarely look important at the beginning. When a major trend starts, it often feels ordinary. The news is unclear. The price action is not dramatic. There is no announcement telling you that a move worth months of gains is about to begin. If it were obvious, do you think the opportunity would still exist? Big moves are born from accumulation, from changing conditions beneath the surface. The crowd usually notices only after the move has already traveled a considerable distance. By then, the risk has increased and the reward has decreased. This leads to an important question: what separates the traders who capture large moves from those who constantly miss them? It is not superior prediction. The market does not reward certainty, it rewards positioning. The trader who catches a major trend is often the one who recognized unusual strength, unusual weakness, or unusual persistence before everyone else became convinced. They did not need to know the future. They needed to recognize behavior. Notice the difference. Price keeps advancing despite negative news. Sellers appear but cannot push the market lower. Pullbacks become shallow. Volume expands at key moments. Something is happening. The market is speaking long before the headlines catch up. Now consider the psychological challenge. Why do traders abandon big opportunities so quickly? Because small profits feel safe. A position starts working. Fear appears. The trader takes the gain. A few days later, the move continues. A few weeks later, it becomes the trend everyone is talking about. Have you ever sold something only to watch it double afterward? That experience teaches a valuable lesson. The hardest part of trading is often not entering correctly. It is staying with a correct position long enough for the market to reward you. Big money is rarely made from constant activity. It is usually made from sitting with a position while others become distracted. This does not mean holding blindly. It means observing carefully. Ask yourself, has the underlying behavior changed, or am I reacting to noise? Those are very different things. A trader focused on big moves spends less energy predicting and more energy observing, less energy forcing trades and more energy waiting for conditions that matter. Look for strength that refuses to disappear. Look for weakness that cannot recover. Look for price behavior that keeps repeating despite attempts to reverse it. Because when a market begins showing those characteristics, it is often revealing something important long before the majority understands it. And once you learn to recognize that process, you start realizing that the biggest opportunities are not hidden by complexity at all. They are hidden by impatience. The market rarely announces a big move before it begins. By the time the evidence becomes overwhelming, the opportunity is no longer the same opportunity. The risk is larger. The distance traveled is greater. The crowd is finally comfortable, and comfort usually arrives late. This creates a problem for every trader. You want confirmation. You want certainty. You want proof that the move is real. Yet the market rewards those who recognize change before certainty exists. Think about it. If everyone can clearly see the trend, who is left to create the next wave of buying or selling? The early stage of a major move often looks incomplete. Price starts behaving differently, but not dramatically differently. A stock that struggled to rally suddenly stops declining. A market that repeatedly failed at a level suddenly holds above it. Small details begin changing before large headlines do. Those details matter because markets move in stages. First, behavior changes. Then perception changes. Only later does consensus change. Most traders reverse that order. They wait for consensus first. But consensus is simply the public acknowledgement of something that has already been developing beneath the surface. The market does not move because people become convinced. People become convinced because the market has already moved. That distinction is critical. When a market begins attracting demand, the evidence is often subtle. Price may advance without excitement. Pullbacks may become shorter. Resistance may stop acting like resistance. None of these signals provide certainty by themselves. That is exactly why they have value. If the evidence were overwhelming, everyone would act on it. If everyone acted on it simultaneously, the favorable pricing would disappear. So the trader's task is not to wait for certainty. The trader's task is to recognize when conditions are becoming different from what they were before. Can you identify the moment when a market stops acting weak, even though it still looks weak? Can you recognize strength before strength becomes obvious? Those questions sit at the center of every large trend. This does not mean anticipating every possible move. It does not mean buying because something might happen. There is an important difference between guessing and observing. Guessing starts with an opinion and looks for evidence. Observing starts with evidence and allows an opinion to form. The trader who enters before confirmation becomes consensus is not acting on hope. He is acting on change. A small change in behavior today can become a large change in perception tomorrow. And when perception changes, capital follows. When capital follows, trends develop. Cause leads to effect. Behavior leads to participation. Participation leads to movement. Movement leads to conviction. By the time conviction appears, the earliest opportunity is gone. This is why experienced traders spend less time asking whether a move has already been validated by everyone else. They spend more time asking a different question. What is the market doing now that it was unable to do before? That question forces attention onto behavior rather than opinion. A market that refuses to decline after bad news is behaving differently. A market that continues advancing despite repeated attempts to stop it is behaving differently. A market that attracts buyers sooner and sooner after each setback is behaving differently. The significance is not in any single event. The significance is in the change itself, because every major move begins as a minor change that most participants dismiss. A surprising truth about big moves is that they do not need a high win rate to be valuable. In fact, some of the largest gains a trader will ever experience come from situations that initially appear uncertain. The market offers a limited risk on one side and a potentially large reward on the other. That imbalance is what matters. This is the asymmetry behind extraordinary trends. Many traders look at a trade and ask, how likely is it to work? That seems reasonable, but it is only half of the equation. A trade can have a high probability of success and still be unattractive if the potential reward is small. On the other hand, a trade can have a moderate probability of success and be extremely attractive if the potential gain is several times larger than the potential loss. The market does not pay you for being right. It pays you for the size of the difference between what you risk and what you gain. Think about a situation where you risk $1 to potentially make 10. You do not need to be right every time. Even a few successful outcomes can outweigh numerous small losses. Why? Because the mathematics are uneven. A small loss removes a little capital. A large gain adds a lot of capital. When that imbalance is repeated over time, the results begin to look very different from the individual trades that produced them. This is why big moves matter so much. They create outcomes that are disproportionate to the initial risk. The trader who understands this stops evaluating opportunities by certainty alone. Instead, he begins evaluating the relationship between risk and potential expansion. That relationship changes everything. A market sitting in a narrow range may not appear exciting. Yet if the downside can be clearly defined, while the upside remains largely unknown, the mathematics become interesting. The loss has a visible boundary. The gain does not. That is where asymmetry begins. Notice what happens when a genuine trend develops. Price does not move 2 or 3 times the initial risk. Sometimes it moves 10 times, 20 times, or more. The trader could not have predicted the exact distance beforehand. But he did not need to. The opportunity existed because the potential reward was open-ended while the risk was comparatively limited. Cause and effect are important here. Limited risk creates staying power. Staying power allows participation. Participation creates exposure to large moves. Large moves create disproportionate returns. Remove any link from that chain and the advantage disappears. Have you ever noticed how one exceptional trade can transform the results of an entire period? Not because it occurred frequently, not because it was guaranteed, but because its size overwhelmed the impact of many ordinary outcomes. That is the power of asymmetry. The market rarely offers certainty, but it occasionally offers favorable mathematics. Those opportunities deserve attention because they do not require perfection. They require imbalance. When evaluating a potential move, focus on the distance between what must be lost if the idea fails and what could be gained if the market unfolds in your favor. Not what is guaranteed. Not what is hoped for. What is possible relative to what is being risked. The bigger that gap becomes, the more attractive the opportunity becomes. Big moves rarely begin with expansion. They begin with restraint. This is one of the most overlooked characteristics of markets. Traders are naturally drawn to movement, yet the foundations of major movement are often built during periods when very little seems to be happening. Price becomes confined. Volatility contracts. The market appears quiet, and because it appears quiet, attention starts to disappear. But beneath that calm surface, something important may be developing. Markets are constantly searching for balance. Buyers and sellers interact until price reaches an area where neither side can gain meaningful control. As this process continues, price becomes compressed within a relatively narrow range. At first glance, this looks like inactivity. In reality, it is a negotiation. Every transaction represents disagreement. One side believes the asset is worth buying. The other believes it is worth selling. The longer this negotiation continues, the more positions accumulate inside that area. That accumulation matters because positions create future obligations. Every buyer eventually becomes a seller. Every seller eventually becomes a buyer. The larger the concentration of positions, the larger the potential reaction once balance is disturbed. This is where pressure begins to build. Imagine a market repeatedly testing the same boundaries. Buyers absorb supply near one edge. Sellers absorb demand near the other. The range persists. What appears stable is actually becoming increasingly sensitive. Why? Because the market is consuming available liquidity. Each test removes some of the orders that previously held price in place. The barriers may still exist, but they are gradually weakening through repeated contact. The market is not merely moving sideways. It is preparing. Eventually one side gains a slight advantage. At first, the advantage may seem insignificant. Price pushes a little further than before. A previous boundary fails to hold. The movement itself is not the important event. The important event is what the movement reveals. It reveals that the balance has changed. And once balance changes, behavior changes. Participants who expected the range to continue must react. New participants recognize the shift. Existing positions begin adjusting. What started as a small imbalance creates additional imbalance. Cause produces effect. Effect produces further cause. The process feeds on itself. This is why major trends often emerge from seemingly unremarkable periods of consolidation. The expansion phase attracts attention, but the compression phase created the conditions for that expansion. Without pressure, there is no release. Without balance, there is no meaningful imbalance. Have you ever noticed how some of the strongest moves emerge after markets have spent weeks or months appearing directionless? That is not a coincidence. The duration of the compression often reflects the amount of energy stored within the structure. A brief pause and a lengthy consolidation are not the same thing. One represents a small interruption. The other represents an extended process of positioning, absorption, and preparation. The market is effectively building a foundation. The significance is not found in predicting exactly when expansion will occur. The significance is found in recognizing what the market is doing while expansion has not yet occurred. Look for repeated tests of important areas. Look for ranges that persist despite multiple attempts to break. Look for situations where price appears trapped, yet continues pressing against one side of the structure. These observations reveal information about the state of the market itself. Because a market that is quietly compressing is often very different from a market that is simply inactive. One is resting, the other is preparing. One of the strangest truths in trading is that some of the best decisions produce no trades at all. This sounds unproductive at first. After all, markets are open every day. Prices are constantly moving. Opportunities seem to be everywhere. Yet the biggest moves rarely appear every day. The problem is that movement and opportunity are not the same thing. A market can be active without offering anything meaningful. It can fluctuate endlessly without creating conditions that justify commitment. The trader who fails to recognize this distinction ends up treating every movement as a decision point. That approach creates noise, and noise makes judgment more difficult. Consider what happens when conditions are unclear. Price may be trapped between competing forces. Direction may change repeatedly. Signals may conflict with one another. Nothing is fully aligned. In these moments, action feels tempting because something is happening. But what exactly are you responding to? A genuine opportunity creates clarity. An undeveloped situation creates questions. The difference matters because decisions carry consequences. Every commitment consumes capital, attention, and flexibility. Once resources are committed, they cannot be deployed elsewhere. This means that every trade is not only a choice to participate, it is also a choice to stop waiting. That second part receives far less attention than it deserves. When you enter a position, you are effectively saying that current conditions are attractive enough to justify abandoning future possibilities. If that judgment is premature, the cost is not limited to the trade itself. The cost includes opportunities that may appear later under better circumstances. This is why patience is not merely a virtue in trading. It is a form of selection. The trader is constantly filtering conditions, separating situations that are merely active from situations that are genuinely meaningful. Have you ever noticed how difficult this can be when markets are moving? Movement creates urgency. Urgency creates pressure to decide. Pressure encourages action before information has fully developed. The chain is predictable, and because it is predictable, it can be recognized. The experienced trader understands that uncertainty itself is information. When the market is sending mixed signals, the confusion is not a problem to solve immediately. It is a condition to observe. Markets reveal themselves through time. Some situations become clearer as additional information appears. Boundaries become better defined. Direction becomes more apparent. Relationships become easier to interpret. The trader who waits gains access to information that did not exist earlier. That information improves the quality of the decision. Notice the sequence. Waiting creates clarity. Clarity improves judgment. Improved judgment increases selectivity. Selectivity increases the likelihood of participating only when conditions justify participation. The goal is not inactivity for its own sake. The goal is avoiding decisions made before the market has provided sufficient evidence. There is a profound difference between refusing to act and choosing not to act. One comes from hesitation. The other comes from evaluation. A trader who understands this begins looking at the market differently. Instead of asking, "What can I trade today?" he starts asking, "Has the market earned a decision from me yet?" That question changes the relationship entirely. Now the burden shifts to the market. The market must present conditions worthy of commitment. Until then, observation remains the correct response. Not because nothing is happening, but because something important is still forming. The search for big moves does not begin with a trade. It begins with a routine. This is something traders often discover later than they should. They focus on entries, exits, and market forecasts. Yet the quality of those decisions is usually determined long before a position is ever opened. A trader's routine decides what he notices, and what he notices determines what opportunities he can recognize. Think about it for a moment. If a major opportunity develops gradually over several weeks, how will you see it if your attention starts fresh every morning? You won't. You may notice the final stage of the move, but you will miss the process that created it. That is why professional routines are built around observation rather than reaction. The market leaves clues over time. A stock that repeatedly appears on a watch list, a sector that continues showing relative strength, a market that quietly changes character over a series of weeks. None of these observations matter in isolation. Their value comes from repetition. When the same behavior continues appearing day after day, it becomes difficult to dismiss as random. This is where routine creates an advantage. The casual participant encounters markets as isolated events. Today is disconnected from yesterday. Yesterday is disconnected from last week. The professional sees continuity. Each session becomes another piece of a larger picture. Because of this, routines are designed to create familiarity. The trader reviews the same groups of markets, the same sectors, the same watch lists, the same developing situations. Why? Because familiarity makes change visible. You cannot recognize change unless you first know what normal looks like. A stock that suddenly behaves differently is only noticeable to someone who has already been watching it. A market showing unusual strength is only obvious to someone who understands its previous behavior. Routine creates that reference point. Without it, every chart looks new. And when every chart looks new, meaningful changes become harder to detect. Notice the cause and effect relationship. Consistent observation creates familiarity. Familiarity reveals change. Change highlights opportunity. Opportunity attracts focused attention. The process begins with routine, not with execution. This is why the trader searching for large opportunities spends considerable time maintaining organized watch lists and reviewing markets systematically. Not because the process is exciting, because it is effective. Big moves are often preceded by subtle developments that would appear insignificant to someone seeing them for the first time. But to the trader who has been observing the same market repeatedly, those developments stand out immediately. The difference is not intelligence. The difference is exposure. Have you ever looked at a chart and felt that something was different even before you could fully explain why? That feeling often comes from accumulated observation. Your mind has absorbed patterns through repetition. When behavior changes, the contrast becomes visible. A structured routine makes that process possible. It transforms market observation from a random activity into a continuous investigation. Each day contributes information. Each review adds context. Each observation builds understanding. Over time, the trader stops searching for opportunities everywhere. Instead, he monitors a smaller group of situations with greater depth. That shift is important. The goal is not to see more markets. The goal is to see the right markets more clearly. A routine built around rare opportunities naturally filters out distractions. It directs attention toward developments that are still unfolding rather than events that have already become obvious. Capturing a big move is not primarily an entry problem. More often, it becomes a holding problem. A trader identifies the opportunity, commits capital, and sees the market begin moving in the expected direction. At that point, it seems as though the difficult part is over. In reality, a different challenge has just begun. Because trends do not travel in straight lines. Even the strongest advances contain pauses. Even the most persistent declines contain rallies. Markets move forward through a series of fluctuations, not through uninterrupted momentum. This creates an important distinction. A position can be right while the market is temporarily moving against it. Many traders struggle with this because they expect a good trade to immediately validate itself. When price hesitates, they interpret normal movement as evidence that something is wrong. The market rarely operates that way. A trend is a process. Processes contain interruptions. Those interruptions are not necessarily signs of failure. In fact, they are often signs of continuation. Think about what must happen during a sustained move. Early participants take profits. New participants enter. Short-term positions are closed. Longer-term positions are established. All of this creates temporary counter-movements. The trend advances, pauses, reorganizes, and advances again. Without those pauses, a move often becomes unstable. The market needs periods of adjustment in order to sustain larger movement. This means that adverse movement and destructive movement are not the same thing. One is a temporary reaction inside an existing trend. The other represents a meaningful deterioration in the trend itself. The ability to distinguish between the two is critical. Why? Because every major move tests conviction through normal adversity. Price retreats. Momentum slows. Progress becomes less obvious. The market creates conditions that make continuation appear uncertain. Yet uncertainty alone does not mean the trend has changed. A market can remain healthy while becoming temporarily uncomfortable. Cause and effect are important here. A strong move attracts participation. Participation creates profit. Profit taking creates pullbacks. Pullbacks create doubt. Doubt causes premature exits. The chain repeats throughout nearly every significant trend. Notice what happens when traders fail to recognize this process. They become increasingly focused on short-term fluctuations. Every pause appears significant. Every retracement demands a response. The position is evaluated through the lens of immediate movement rather than the broader trend. As a result, normal adversity achieves what actual trend reversals could not. It forces the trader out. Have you ever exited a position during a routine pullback, only to watch the trend resume shortly afterward? The experience is frustrating because the market itself was not the problem. The interpretation of the movement was the problem. The market behaved normally. The trader treated normal behavior as abnormal. This is why effective trade management requires understanding the character of the trend being held. Strong trends rarely move without interruption. Weak trends rarely survive repeated interruptions. The distinction matters. A healthy trend often demonstrates resilience after periods of pressure. It absorbs selling and continues higher. It absorbs buying pressure and continues lower. The temporary adversity fails to alter the underlying direction. That resilience provides information. Not about prediction, about condition. The trader's task is to observe whether the trend continues behaving like itself despite temporary setbacks. If it does, the adversity may simply be part of the process. If it does not, the situation may be changing. The goal is not to eliminate discomfort. The goal is to correctly interpret it, because the market often demands a price for participation in large moves. That price is not always financial. Frequently, it is the willingness to endure periods where progress becomes less visible, even though the broader trend remains intact. One of the most expensive mistakes in trading rarely feels like a mistake when it happens. It feels responsible. A position moves in your favor. A profit appears on the screen. You take it. The trade is closed successfully. There is no loss, no obvious error, no dramatic failure. Yet months later, when reviewing the move that followed, you realize the true cost was not what you lost. It was what you stopped yourself from gaining. This is the small profit trap. The trap exists because profits are emotionally persuasive. Once a gain becomes visible, protecting it begins to feel more important than expanding it. The focus quietly shifts from opportunity to preservation, and that shift changes behavior. Instead of evaluating the potential of the move, the trader becomes occupied with the existence of the profit. The larger question disappears. Only the current gain remains. Think about how often this happens. A position advances. The trader sees a return that feels meaningful relative to recent results. The trade is closed. Shortly afterward, the market continues in the same direction and travels several times farther than the original gain. The pattern repeats so frequently that many traders begin believing they are simply unlucky, but luck is rarely the explanation. The problem is structural. The trader has developed a habit of measuring success by the act of taking profit, rather than by the quality of the opportunity being held. That distinction matters, because markets do not distribute rewards evenly. A large number of opportunities produce ordinary results. A small number produce extraordinary results. If those exceptional opportunities are repeatedly converted into ordinary gains, their unique value disappears. The trader receives the outcome of an average trade from a potentially exceptional one. Cause and effect become clear. Small objectives encourage early exits. Early exits prevent participation in larger moves. Reduced participation limits exceptional outcomes. The trading record becomes dominated by modest gains, regardless of how powerful some opportunities may have been. This creates a hidden paradox. The trader may become highly successful at collecting profits, while simultaneously becoming ineffective at capturing major opportunities. The account grows through accumulation, but never benefits from expansion. The difference is significant. Big moves possess characteristics that smaller moves do not. Their potential cannot always be measured in advance. Their development often exceeds initial expectations. Their importance emerges over time. When a trader automatically converts every gain into a realized profit, the possibility of participating in that larger development disappears. Have you ever noticed how easy it is to imagine a loss after a profit appears? A gain feels temporary. The mind immediately begins calculating what could be surrendered. Attention shifts toward protecting the existing result. Yet the market has not necessarily changed. Only the focus has changed. This is why the small profit trap is so deceptive. It disguises itself as prudence.